Coming up next on the Cash Compound podcast, ladies and gentlemen, boys and girls, a special guest straight off TikTok. Here we go. Welcome back. It is J.D. of the Banking Bros, and I've got a guest almost in studio today. He's coming to us from, I actually have no idea, because in TikTok land, they could be anywhere. Maybe he's a bot, ladies and gentlemen. But I'd like to introduce you all to Tax Free Mike. What's up, man? I appreciate you being here. Thanks for coming.
Hey, how's it going? Thanks for having me.
Yeah, man, we are pumped to have you here because I've been following, right? I don't follow everybody out there, but Tax Free Mike is a guy who has been in my, thread or feed or whatever they call it on TikTok from the Banking Bros channel
for the last, I guess.
The For You, right? FYP. Yeah. I'm not sure, but I like his style, and we're going to chop it up and debate him on a couple of the claims that he makes to see if this whole infinite banking and permanent life insurance idea is going to hold up in the way that he teaches and preaches and what he does personally. So, Mike, give us a little bit, man, on your background. Tell us where you were out there in the world before you were using this crazy tickety talk thing. So tell me about yourself.
Yeah, so out of college, 2014 was when I graduated from University of Michigan. I got a job in like a normal kind of corporate 9-to-5 world, in like a sales and marketing kind of position. Wasn't super happy and fulfilled there. And a friend of mine, who's also someone who you probably know on social media as well, Sneller Financial, Ron Sneller.
Yeah, Ron, for sure.
He's another big infinite banking guy. Talks a lot about insurance. He's a licensed investment advisor as well. He's got his securities licensing, and so he was working at a fraternal insurance carrier, and I had known him for a long time because he actually used to be my teacher when I was in like 7th or 8th grade.
Oh, really? Okay.
Yeah. So that's kind of how I knew him. And so anyway, long story short, we were friends on Facebook. He posted something on Facebook that he was looking for new advisors at this fraternal carrier. And I was thinking, I'm not really that satisfied where I'm at in this corporate world. This sounds like something that I might enjoy. What's the worst that could happen? Let's just have a conversation. So I messaged him, and then he said that he would bring me on and help me, with licensing, getting prepared and getting the licensing courses and all that stuff squared away. And then he kind of like took me under his wing and mentored me, and we left the fraternal world in 2020. Because it was during the pandemic. We left the fraternal world and went more the independent route, where we can have a variety of different options for the client, where we can focus a little bit more on the infinite banking. Because and when we were first kind of getting into the business, it was more, a lot of term life insurance, which is fine. There's nothing wrong with that. Some IRA rollovers into annuities and some whole life insurance, but it was largely more for the death benefit. It wasn't really structured a whole lot around the cash accumulation, the infinite banking strategy itself. And as we started to learn a little bit more about how you can do that with a properly designed insurance contract, we realized that, hey, this fraternal carrier, they don't have an option for this. And we really want to be able to offer it to our clients. And if we stay here, we just can't do that. So we went independent so we could offer the infinite banking strategy. And been here ever since. So social media really blew up for me and for Ron in the last quarter of 2021. Yeah, I want to say it was like August or October in 2021 when one of my videos first went really, really well. And then I actually started getting people messaging me because I did it mostly as like an educational, financial educational type thing, just to, have a brand. And people were messaging me, oh my gosh, I've heard about this. I don't know who to talk to. Can you help me? Are you licensed in blah, blah, blah state? Or who can you put me in touch with who can help me with this? And I just started thinking like, I should probably just get licensed in all these other states. And then instead of saying, sorry, I don't know anyone who I can put you in touch with, I can say, actually, yeah, I am licensed in Tennessee, or I am licensed in California. I can help you do it. So I just got licensed everywhere, and now I pretty much have an exclusive online model.
Right.
People find me from social media. We set up video meetings, and if they want to do something, I can help them do it and set up the policy for them and manage the maintenance of the policy, review from time to time, and all that. So that's kind of where I'm at now.
Interesting, man. What a journey. Yeah, because we do the same thing, basically have a virtual office. We're physically located on the East Coast, but this virtual office and this idea of utilizing social media, has connected us,
right,
all 50 states, Puerto Rico as well. My brother spoke there last year. So
nice.
Really all over. Crazy. So here's one question that we have to ask as we get into it is, how do you define infinite banking? What is infinite banking, Mike?
That's a great question. I think the thing that I really like that I've heard from like people like Chris Naugle and Mr. Burr, Devin Burr, and this really resonates with me, that infinite banking is more of a concept, not necessarily the actual product that you use to execute the concept. And to me, infinite banking is putting yourself in a position with your finances to have a little bit more control over your money, where you can access your money without tax penalties or fees at any age, and capture uninterrupted compound interest, which you can use in a variety of different ways. You can just buy a car and use it as consumption. Hey, instead of paying cash for this car, like Dave Ramsey says, why don't we do the infinite banking concept and we'll pay ourselves back. We'll get the uninterrupted compound interest that we never would have had if we paid cash, like Dave Ramsey says. So you're better off. Or if you want to take it to the next level, like people like Chris Naugle or Devin Burr, we can use that concept to increase the spread that we're going to make on an investment, like a rental property, or maybe we take that car and instead of just driving it ourselves and using it as a consumption vehicle, we use it as an investment vehicle and rent it out on Turo and we make some money. Or we, the thing that I thought was super interesting, I saw Chris Naugle doing lately is flipping equipment, like a fork truck or something he bought with his policy, had a guy fix it up and flip it and sell it, put the money back into his policy. Like, I think the infinite banking concept is before you even get to that level, we're kind of thinking like, hey, how can we do what the bank does with our money? And at the macro level, we know we have a pretty good idea what the banks are doing at the macro level. How can we take that and on the micro level and do that for ourselves individually, financially? And it just so happens to be that a properly designed cash accumulating life insurance policy is, in my opinion, the best actual product that can help you execute on that infinite banking concept. So,
yeah, man. Why do you think that, your opinion, you mentioned Dave Ramsey. I was a big fan of his, got out of debt using his model when I just had full loans quite a while ago, and had no idea about this concept prior to 2015 is when I first got involved. 2016, got myself my first policy, and I've got a whole handful plus of them now. But what do you think, and where does it come from that most people just don't understand how whole life, how permanent life, how indexed life could be used for cash. They just don't get it. Where do you think that mindset has come from? Why do they think you're crazy? I read some of your DMs, man.
Sure.
I see those comments. I'm sure you're getting stuff like I'm getting them. So what is it that people just don't seem to know?
I think that's really an interesting question. And I think there's an entire financial matrix designed to keep people ignorant. Not to get like conspiratorial or anything like that, but the financial system that we have benefits enormously. And I don't say this lightly, but it benefits enormously for the average American to be a financial slave. And there's not the education about this, because the minute people know that they can have more control over their money, that they can have more financial independence, they can't be controlled. If you have control over your money, someone can't control you. And the banks, Wall Street, your employer, they want to be able to have more power over you. And I think that's a big reason why we don't know about this, that there's not really any monetary incentive for the average person to know about it. And our financial system is designed around people having their money where it is right now. So what would it benefit them for you to know about something different? Because then you're going to move your money. You're not going to leave it where it is, and they're not going to get the ability to lend money based on your cash reserves, or invest your money into the S&P 500 and get asset under management fees, and put it into a mutual fund. And again, not that any of those things are bad, but it's just that the average person likely would benefit from having some of their money that's not in that system, that they do have control over, that they do have access to, that they do get good tax benefits on, that they do get uninterrupted compound interest. So I think the entire system is designed to make money on your money being in other places. So like, why would they tell you about it?
I love it, man. So here's my question. As we try to help people understand that you can be involved in a monetary system by partnering up with a mutual insurance company, as opposed to some of those things that the Matrix is designed for you, where you already have your money, right? We're not starting with babies. People are grown. Right. People have been to college. People are already working. People are utilizing loans, all these types of things. Why is it, and how do you describe the difference between those systems and those institutions and mutual insurance? Because some people are like, why would I just give my money to those people? If I give my money to the insurance company, like I do now for my cars and my fire insurance and my home insurance and my property insurance, now they have it. What's the difference between Wall Street, let's say,
sure,
and an insurance? If I give them my money, then they have it and I still don't have it.
Yeah, that's actually a really good question, because ultimately that's what people are like, when you kind of go down that rabbit hole and you don't really give people like a good solution, and oh, hey, let's put on our tinfoil hats and everybody's out to get us and we can't have our money anywhere because someone's always going to exploit us. I might as well just put my money under my mattress. Well, that doesn't work either, because now your money's not working for you. Your money's not growing. So I mean, there has to be some level of trust. And it's I can't remember who said it. I think it might have been like St. Augustine, or maybe it was like Socrates or Plato, but someone there's like a famous quote. I can't remember who it was attributed to, but something to the tune of like, I'm only standing here because I'm standing on the shoulders of giants, of people who did things in the past, and I'm relying on the things that they did so that I can achieve what I'm achieving now. I mean, to some degree, you do have to have a level of trust in somebody else or someone else who has the expertise that you need to be successful. But I think before, like after we kind of realize that it's like, yeah, I mean, if you don't have any level of trust at all, then, you can just go live in the woods. But I mean, do you really want to do that? No. So once we get past that, we can really see the business model of a mutual life insurance company being quite a bit different than like a bank or Wall Street, because the mutual life insurance company, in the name, it's mutually owned. So who really owns the insurance company? Well, yeah, you're giving your money to the insurance company, and you have to have that aforementioned level of trust there. But here's the thing. When you're putting your money in a mutual life insurance company, you're not just giving them your money and just hoping that everything goes well. You're actually becoming a part owner in that mutual insurance company, because by definition, a mutual insurance company, they're not a publicly traded institution where they're subservient to shareholders on Wall Street or, Warren Buffett. There's not people making secret deals behind closed doors. When you put your money into a whole life insurance policy, that's a participating policy, you earn dividends, you're a part owner in that company. So the company has a direct incentive to be profitable, to have low cost, to have a good, clean operating business, because as a part owner, you're going to demand certain things, right? You're going to want an attractive dividend. You're going to want a competitive internal cost of insurance. So the insurance company is incentivized by the nature of their business model to deliver value back to you, because you're kind of like a shareholder in a way.
Right.
So I think the business model of the insurance company is distinctly different from a lot of the other financial institutions. And being insurance, they're also regulated differently. They're much, and this is something I'm sure you are too, getting a lot of questions about the safety of their savings or their checking account or their money market after these big banks failing in the earlier part of this year. We're not really hearing a whole lot more about that, but the banking system is still pretty vulnerable, and the insurance companies are 100% reserve, which means every premium dollar you have in your policy is backed up by $1 of reserved asset. The banks don't have that. They have fractional reserve, which means they only have 10 cents on the dollar, if they even have that.
Right.
So, not only are they sharing the profits that the insurance company makes back with you, and you're a part owner in the insurance company, but they also are much better capitalized and much safer to weather some of these economic firestorms that may be headed our way. So yeah, I think the entire business model of the insurance company is very different, which gives the average person a lot more confidence, knowing that not only is their money going to be safe, but the insurance company is directly incentivized to offer me as much as they possibly can, because I'm now in a partnership with the company.
I love how you said it. That's really what it is. It's why we choose mutual insurance companies. We broker between about 5 or 6 different ones. And I tell people all the time that out of my 8 personally owned policies that I have with permanent insurance, it's 3 different mutual companies. And I am eager to potentially start another 1 or 2 policies with some of our other partners out there to really help our clients and our customers understand the inner workings and how they treat customer service, and can you really get loans out there? It's very interesting. So now at these mutual companies, Tax-Free Mike, let's start to stop agreeing on everything. These people sell multiple things. They sell multiple things out there, right? I tell people all the time that we at the Banking Bros Cash Compound, we're going to use mutual insurance companies. We're going to set up the policy for your cash use, and you got to get the right type of contract or policy from them. So we're not going to buy car insurance from these folks. We're not going to buy candy out of the lobby. We are going to buy whole life insurance, the kind that I always say is guaranteed to grow and cash flow. All 3 of those things. And if you see anything about what we do, especially when we try to break it down for those people who are passing us by on the FYP page on TikTok and stuff, real quick, the 3-cup setup. That really helps people. I go live a lot there. So guaranteed cup number 1, premiums. We often say premium deposit. Guaranteed to grow, that's cup 3. Cup 3 is the death benefit. So the numbers you put in are guaranteed to be bigger on the other side. And then cash flow and it's just a rhyme little jingle here, guaranteed to grow in cash flow, is cup number 2 in the middle. The green one is our cash value, which is our net equity, our present value for our future benefit, which is the third cup, the death benefit. So that's cup 1, 2, and 3. But that is not the only product out there for the process you mentioned. Everybody else out there, it seems, keep saying that there's a better, superior, different product to do this process from. Don't worry, it's going to work, and it's going to work better. And that is that pesky little, in my opinion, indexed universal life insurance policy. Mike, tell us what you believe. Tell us what is true. Tell us your opinion, and help us understand the difference, man.
Yeah, I think there is a big, especially in social media, there's a little war going on, and a little turf war. You know, it's like you
get all these keyboard warriors going at you, right?
Like the Bloods and the Crips, man. They're going after each other. You know, they're fighting over territory about this insurance stuff. So I mean, here's what I think about the IUL. Well, I guess you asked me first, like what's the difference? I guess I'll kind of briefly explain the difference and then tell you what I think about it. The IUL, Index Universal Life, and dividend paying whole life insurance, they are different. So the whole life insurance policy has a lot more of the contractual obligations on the insurance carrier, because they pay out dividends. They have guarantees in the cash value, guarantees in the premiums, guarantees on the costs that are all locked in. They can't 10 years later say, oof, you know, we're not doing as well as we thought. So, you know, the cost of insurance is gonna be a little bit, it's gonna go up. They can't do that. Now they can lower dividends, and technically they cannot pay any dividends at all, but that's exceedingly rare, because as I mentioned earlier about you kind of being like in a partnership with the insurance company, the minute they stop paying dividends, there's a pretty good chance that you're going to be upset, and a lot of people are going to move their money to their competitor who does pay dividends. So they do have an incentive to pay dividends. So there's a lot of obligations on the shoulders of the insurance company, a little bit more on them than there is on the client. The obligation to the client with the whole life insurance policy is that they pay their premium. That's about it.
Unilateral contract. Yeah, unilateral contract. Stay alive and pay some premium. That's correct. Everything else is 100 pages they have to do.
Correct. Yeah. Now with the Index Universal Life, it's a little bit more of a split. There's a little bit more obligations that the insurance company tried to shed. And this is kind of in the period of slowly, gradually declining interest rates. Because one of the big ways the insurance companies make profits are their fixed income investments. So they are very risk averse, and that's why the insurance companies are able to pay competitive returns and decent dividends during really any type of economy, whether we're in a boom or a bust or a 2008 style recession. If you have a whole life insurance policy, you're getting your dividend rate really no matter what's going on in the economy, which is fantastic. But a lot of that is based on interest rates where, you know, hey, it doesn't matter that 2008 is happening if you have a basket of bonds or treasuries that are paying, 5%. Okay, the S&P 500 went down 50%, but I still have my treasuries or my bonds that are paying me 5%. So what do I care? Right. So a big part of the profitability from the insurance company is the spread that they're making on some of that on some of those fixed income investments. Well, interest rates have been zero for a really long time, and even before interest rates were zero in the 90s, going into the early 2000s, they were like 1%. So I mean, you had about 40 odd years of interest rates being super low. And the insurance companies are kind of like looking down the tunnel of time, and they're like, ooh, this is not what it used to be. Like we used to be able to make, 5%, 6% on our bonds, and interest rates, they're kind of staying low. They're not going back up. Like we might need to change things a little bit if we want to make more of a profit. So enter the IUL. The insurance company doesn't have to pay a fixed dividend rate in a low interest rate environment. They can get a return that's still fairly competitive on the cash value in the policy, but it's not as fixed. There's not quite as many guarantees, and if, for example, they're competing with someone like Mass Mutual who pays a 6% dividend, well, Mass Mutual, if they're paying a 6% dividend, they're paying that 6% dividend no matter what. But if we're looking at the IUL company, they say, hey, the growth in your cash value, there is no fixed dividend, there is no 6% dividend. It's if it depends on what's going on in the S&P, and hey, guess what? Sometimes it's up, sometimes it's down. There's not really a guarantee there at all. So it kind of gets the insurance company to be to make a little bit more of a profit, because they don't have to guarantee as much, they don't have to promise as much, but at the same time, there's a little bit less certainty there for the client. Now that makes it sound kind of scary and kind of ugly, like, oh wow, why would I ever want to do that? It sounds like this is really bad, and I think some of the negative of the IUL is exaggerated, because there's not as much guaranteed, which is true. Your return isn't as guaranteed, and you can't really predict what you're going to get from year to year like you can with the whole life insurance policy, which makes the whole life policy, I think, a little bit more attractive for the infinite banking concept, because you want to have the confidence of knowing that, hey, if I borrow against my policy this year, am I going to get growth on my cash value, or is it going to be a year where I get zero on my cash value? And what happens if I deploy my cash value to purchase a rental property or to buy a car, and I'm paying the loan interest and I'm paying the loan back to myself, and I happen to get a no return on my internal cash value? Like that kind of defeats the whole infinite banking purpose. So I think the IUL is a little bit more appropriate for like a tax-free income vehicle. Like we put money into the policy for a few years, and then maybe we use the cash for income later on in retirement or like pre-retirement, because there is a little bit less predictable there from year to year. If we zoom out far enough over like a 10, 15, 20-year period, because the performance of the IUL tracks the S&P. Essentially, the insurance company buys 1-year call options, and depending on how those call options turn out, they're sharing the profits they make with those options into your cash value. So if the S&P goes up 10%, hey, you might get somewhere between 7 to 10% on your policy's cash value. So if you're looking at a whole life policy that pays, say, a 5% dividend, and you're like, oh, hey, well, this sounds like the greatest thing since sliced bread. If I have this dividend that gets me 5%, but then the S&P goes up 10, well, hey, I made way more by just doing an IUL. But then the inverse can happen where, hey, the S&P went down 30%. So the insurance company lets those 1-year call options expire worthless, so you don't actually take an investment loss there, but you're also not going to make anything. So now that 5% dividend sounds pretty attractive when you get a 0% growth on your cash value. So from year to year, it's kind of hard to predict what the IUL is going to do, because it's going to depend on what's going on in the S&P. But when you zoom out far enough, you can say, oh, hey, look, if we look back 20 years or 30 years, the S&P has an average of 7% or 8% or whatever. So you can have a pretty good idea what the IUL is going to do when you look far enough down like a long enough time horizon. So I think it's a little bit more appropriate for supplementing our income in retirement, or if we're in a bull market. Usually a bull market will last anywhere from like 6 to 10 years. That could be a a decent time to borrow against the policy because you're going to probably get some positive arbitrage there. But we would want to pay that loan off as soon as we can. Like if we borrow against it, try to pay it off in like 4 to 5 years. Because again, a bull market usually lasts 6 to 10 years, and then we're going into that bear market where you're going to get no growth on the cash value. So you have to, if you're going to use the IUL for infinite banking, I think you have to be way more strategic about it, and probably even more disciplined, because you're going to want to pay that loan off as soon as you possibly can, because you're not going to be able to tell how the cash is going to perform quite as much as you can with a whole life policy.
So a couple questions about that. When you say, knowing that I'm not as versed in IUL performance or growth, in a whole life contract, you're getting your gains. We'll call it a gain here, but it's a guaranteed gain, as well as a potential dividend, right? So the dividends are potential, but they'll illustrate both of these for you. You know what's guaranteed to. So the way you said it, though, has me wondering a question here. I want to make sure I get a clarification even for me, is we're going to get that growth in whole life based on what we've put in, our premiums, not based on our cash value. The way you said IUL is, are we getting returns based on cash value we've left in the game?
So the insurance company, they give you the return on your, like the interest rate that they call it interest crediting instead of like a dividend. Similar concept though. So they pay that out on your entire cash value balance. So if we have got it,
so that's obviously, if you're thinking the way I'm thinking, and I think you and I are here, but the average person listening may not understand what we said here, is we're going to get guaranteed growth once again on what we've put in over the course of our whole life. That's why we always say words like that. And in insurance, those words mean something, right? In other market products, you may not mean anything, but everything we put into that premium at that point is going to be growing and getting new guarantees from. Okay, but in IUL, you're saying that if we pull some of those dollars, we're going to borrow against our policy's value, cash value. We'll try to get as technical as we can here to make sure we don't mislead people. They understand. Then we have some out. Let's say we deploy some of those dollars for investments, right? We're going to go get great investment returns. We're not even here talking about that. But if we pull it out of the policy, and that policy in that particular year, at the end of that time, when they look to see what's there, we're not going to get growth on stuff that's out. Is that what you're saying?
Oh, okay. I see what you're saying. Yeah. So yes, you will. So say you have $100K in cash value and you borrow 50 to use as a down payment for a property. They're going to credit you interest on all the $100K in cash value. So even if you have a loan against it for $50,000 to go invest somewhere else.
Got it. And because now, obviously, we're nuancing the words here, and part of it is to make sure I'm clear on what you're saying, is because you don't get it off of the cash value. You get it off of the premiums you put in. You get growth, you get crediting off of what you've put in, not on what you've borrowed.
Yeah, you do get crediting on all of it. So you get crediting on the unloaned cash value and the loaned cash value. They credit you interest on the entire amount. Is that what you're asking? I just want to make sure I understand your question.
Well, I just want to make sure too. I'm not sure. So what I'm saying is what I'm saying, the difference in the words is we're getting our crediting in an IUL. If you're going to do that and you get crediting, it's not based on your premiums. You're saying it is based on cash values.
Yeah, it's based on your total cash value. Yeah, the total cash value you have in the policy. Because how the IUL works is there's a cost of insurance deduction, and it comes out of the cash value. So it's not necessarily, it's just the way they calculate the cost is different than a whole life policy. So the cost of insurance gets deducted from the cash value every single year, and generally the insurance carrier will they'll credit the interest that say the S&P went up 7% and they give you 7%. So they're going to credit 7% on your total cash value that you have in the policy.
And
you're going to get 7%, and then they're going to deduct the cost of insurance after that.
Got it. Right.
So,
right. And of course,
one thing that
of course, I've got to bring up to people who want to talk to us and be reminded that the cost of that insurance and the charges on that insurance rise every year in an IUL. Now, it's probably not going to be felt, right? I mean, you and I know that. It's not going to be felt for 10, 20 years, depending on your age. However, there is a cost, and it's rising annual renewable term, and that for most people will become cost prohibitive if the cash value is not covering it, but it will become cost prohibitive at a certain age for the regular person who's doing this.
It can if it's not funded correctly.
Right.
So if we design, and this also kind of depends on how the policy's structured too. Because I've seen some horror stories where someone got an IUL and they had a really large death benefit. It wasn't designed with minimum death benefit, and they were paying like the target premium, which is like the recommended premium, but not necessarily the maximum premium. So, they got a big death benefit and they're only paying like the recommended premium, not the maximum premium. And so 10, 15, 20 years down the line, you have more death benefit than is necessary, and also underfunding. And you can't do that for very long with an IUL before it comes to be a huge problem. In my opinion, if someone's going to do an IUL and they want to use the cash value, they're going to want to design it with the minimum death benefit possible. Say they want to put away $1,000 a month. Buy the smallest amount of death benefit you possibly can for a 40-year-old male doing $1,000 a month. And design the policy so that $1,000 a month is the max funded premium, so that you're basically squirreling away as much cash as you possibly can into that policy, and it's keeping the costs controlled, keeping the costs low as we possibly can. And so over time, if the policy is designed the right way and it's funded the right way, the cost of insurance averages to be about 1%, sometimes even less depending on the carrier. So if the cash value averages like a 5 to 7% return and you have a 1% cost of insurance deduction, you're staying ahead of the game, even when you're 60, 70 odd years old, when those costs of insurance are higher, because your cash value is still growing as well. So
we hope
percentage wise. Oh yeah, sorry. Go ahead.
Yeah, no, I was just saying we hope.
Oh yeah, yeah, sure. Yeah, I mean, there's, and that's why I think you want to be extremely discriminating when you're picking an IUL, because since the cost of insurance can go up beyond what we expect, we want to be even pickier.
If you live old enough, right? So what's interesting that I tell people is just making sure, and I know in a couple of seconds, we want to see something that you've got. So go ahead, and it may take you a second to put them up.
Yeah.
But I try to help people understand and ask them questions. If you wanted to use this IUL product in retirement, which is a word we don't use very much when we've got cash value always available. Doesn't matter if you're retired or not. It's always going to be more, and we know what it is. Charges are already taken out. We can see it. We know what's going to be the guaranteed minimum here. But if you're going to utilize an IUL for the idea of retirement, which most IUL salespeople and coaches are going to talk about, they're going to say that word a lot, retirement.
Sure.
In retirement, your charges are going up. You better hope that the performance worked throughout your working years or working career or those ages, because now is when you want to utilize it. And if you want to utilize it in that retirement time, in that now 65, whatever that age may be for you, that's when you're most vulnerable. You better hope you have enough, because you're most vulnerable, because at this point you're going to have to work again, and you might even lose that death benefit if you just didn't understand this thing could lapse on you if it starts cannibalizing its own cash, what you thought you were going to use. So I'm not here to be mad at the message. It's the messenger's message sometimes that has thrown people off. If you're going to use it in retirement, you better hope that the money was there. Lightning may have had to strike you particularly, or this policy, 2 times at that point. And if you run out of money and lose that contract, There, you ain't got no more time. So,
right.
the problem
Yeah.
with the way IUL is marketed by many people out there is the idea that it can be used for cash and it's going to be better than a whole life. But we don't know that. You just don't know.
Yeah, I mean, there's a little bit of uncertainty there. I mean, we can say that we expect the IUL to perform comparable or maybe even a little bit better. But there is going to be some because again, I mean, we can look at the because it tracks the S&P 500, so we can look at the S&P going all the way back to like 1920, and we can say, well, hey, we have over 100 years worth of data. We have a pretty good idea on how things are going to look. But I mean, there's a thing in investment circles that is pretty much a disclosure on every mutual fund, every index fund, every managed fund that past performance isn't a guarantee or a predictor necessarily of future performance, which I mean, it is true. And that's where some of the uncertainty comes in with the IUL is, I mean, to your point, I mean, we have a lot of data that we can go off of and we can look at and say, well, hey, I mean, we can make some pretty good educated guesses, but at the end of the day, we do we're not exactly sure that it's going to perform well, I mean, I guess you could say that about anything really, but
of course. And now illustrations, and that's where we get in trouble. Illustrations in whole life insurance will not be accurate either. The illustration will not be accurate, but we know it's got guaranteed cash in there.
Right. So there is some difference there for sure.
And the other thing is, of course, we've got to talk about that sequence of returns. While your dollars are still inside this policy in your latter years, let's say retirement, you're drawing, let's assume, you're drawing them for supplemental retirement income. You're drawing them for ideas that you want to go and get in investments with. Well, now once again, those charges are going up. They are going up during that time, and you're drawing money out at the same time. So obviously that's theory because I don't know if you're going to use it at all, right? We don't know if the people are going to utilize the money at all. But the point was you were going to use the money. So if you start using the money, you got to understand if there ain't enough in there, charges are going high. You live long enough, you just understand. So it's going to be, but anyway, let's jump into, I want to see, we just got a couple more minutes here.
Yeah.
You want to see, how you might structure a policy or give us the 5 fun facts of how you might put something together for people. And I know you utilize whole life as well. So I'm not, the point is we, both of us are utilizing whole life. You've got personal contracts and all that, but I wanted to talk about some of the differences in thought, opinion, or product as well. So why don't you pull up a little and give us 5 fun facts on what you see, what you do, how you might advise somebody, and what's going on inside IUL.
Yeah. So you want me to pull up my screen here?
Yeah, if you can. We'd see it. We're podcasting, but we're also vodcasting for some of our friends who look at us on YouTube as well and other places. So tell us a little bit.
See that at all?
We can see that. So give us some facts in here.
Yeah, so this is to your point about using it for income and retirement and trying to be aware of predictability on the performance and the insurance charges. That's why we want to be pretty picky about the company. In my opinion, like kind of how we were talking earlier about the whole financial matrix, not really wanting people to know about whole life insurance and the infinite banking concept because they want your money where it is. That's where the rest of these institutions are making their money. So, what incentive do they have for you to know about these types of things? And in my opinion, if we're going to do an IUL, I think it makes sense to try to keep that mindset as much as we possibly can. So I try to avoid the publicly traded companies when we're doing IUL. I prefer to use the companies that are privately owned, where they still have some of that insulation from, like, again, the shareholders on Wall Street and all that good stuff. So I think that's one thing we want to keep in mind. Private ownership is nice. This company that I'm using for my IUL, they're an ESOP company, which I think is pretty attractive. I mean, for the IUL, because a lot of the IUL companies are publicly traded. They were mutual insurance companies that demutualized and became publicly traded companies. So I think if we're going to do an IUL, I mean, there's tons of big ones out there. A huge IUL. You'll see a lot of the guys on TikTok too talking about IULs, and most of them are the bigger publicly traded companies. Which there's nothing inherently wrong with that, but I think that is a risk multiplier a little bit when it comes to the cost of insurance. So we want, in my opinion, if we're going to use it as a cash accumulating asset, income in retirement, or supplemental cash flow, when we're in our 60s or 70s or what have you, I think we're just going to mitigate that risk pretty significantly if we're with a company that isn't, again, putting that shareholder before you. So that's one thing I want to that can really help. And then again, minimum death benefit, max funding it, so we're funding it properly. Even if the policy, and we want to stress test it. That's another big thing, because some IUL carriers have higher internal insurance expenses, and we want to make sure that we're working with a carrier that's at least in the middle of the pack or at the lower end of the deal there, and run an illustration with the IUL. Getting a little bit of a lower return than has historically performed. So when I did my IUL, generally over the last 20 years, most of the IULs are somewhere in like the 6 to 8% range. Like an average return, somewhere in the 6 to 8%. So I think it's a good idea when you're doing an IUL illustration to run an illustration somewhere around, like, to stress test it, maybe run it at like 4.5%, 5%. And if the policy still performs, pretty satisfactorily, then you probably have a good IUL. And if you run it at, 5% or 4.5%, and it implodes and lapses on you in the illustration, that could be a little bit of a problem there, because if it does historically 6 to 8%, but you run it at 4.5 or 5, and it works out that the policy ends up, lapsing at like, 75 or whatever, that's kind of a red flag. Because if it doesn't perform as you're expecting, even if it has historically performed in the 6 to 8% range, again, there's just a little bit more uncertainty because it does track the S&P. So, there's the chance it could do better. There's a chance it could do a little bit worse. We're not quite sure. We can make some educated guesses, but I mean, these are some things that we want to do when we're getting an IUL. We want to stress test it. We want to run some conservative illustrations, and also have an idea of what the historical performance of the IUL is with that carrier, to give the client a little bit more predictability in what they're going to have, or what the potential of their cash value to be in 15, 20, 25, 30 odd years. So I think all of those things help. Yeah, go ahead. Yeah, feel free to start. I'm kind of going off on a tangent.
We're good. We're good, man. But let's take a look here, and let me ask a few questions about what we see here. So number one, in a lot of people's IUL contracts, is there is no cash surrender value in the first years of the policy. There's a lot of surrender charges. So are you saying here that what you've got, first off, you built in a $4,700 cash value that is available in the opening year of this policy when you've deposited $10,000 in the premium? Is that what we're looking at here across, year one, for everybody who's not figuring out where I am? So we've got $10,000 deposited in premiums. Of course, I use the word deposit, but $4,700 available.
Yeah. So this is the This is kind of where it's a little different with the IUL. So on the guaranteed column, you see where it actually is my highlighter thing working?
Yes, your highlighter's working. Perfect.
Okay, good.
So go ahead.
So where it says maximum charges, that's under the assumption that because there's a range of cost of insurance charges that the IUL carrier can charge. And so on the guaranteed column, they're assuming that they raise the cost up to the guaranteed maximum, which is basically like triple what the carrier charges currently. So the column, the columns that are most realistic, if we're with a good carrier, because there are some carriers that have gone deviated from their projected cost of insurance charges. And again, that's another thing where it comes to be picky with a carrier. We want to pick a carrier that hasn't done that, that has stuck to their cost of insurance charges, and that is information that is available. You can get that from the carrier. So my carrier that's done IUL, they've never deviated from their cost of insurance projection. So even somebody who got an IUL 20 years ago, they're still on the same cost of insurance table that was shown them 20 years ago. So that gives me some comfort. So the sections we kind of want to look at are going to be like closer to these ones because these have the current charges. Now, the only thing that they're showing differently is the actual performance that the IUL is making. So in real life, I mean, it could be a little bit better than
but we just don't know, and most people just don't understand that. So we don't know how the index and how our relationship to that index is going to perform. But this one is illustrating 3.5 and a 6, two different.
And it could even be somewhere in between. And again, that's kind of why we want to stress test it a little bit, run it at 4.5, 5, because historically. Most IULs are somewhere in the 6 to 8% range. If you look at the last 20, 25 odd years, give or take.
No, and of course that is also average. So we've got to understand that S&P normally is going to be 0, 3 out of 10 years, 2 out of 10 years.
Right. Yes, you can get some zeros.
0.
For sure.
Yes.
For sure. You can get some zeros.
Yeah. And so we all know that. That's the market. But what I'm trying to make sure that we point out on this conversation is in a 0 year, which is going to happen. It just happens. And that doesn't mean that you went negative 30, right? Because the S&P may have that. You went 0. And if you do, that these numbers are, these numbers are made up at that point, right? Most people don't understand that, is all I'm saying.
Yeah. I mean, there's going to be some zeros. And I tell people that too. When we do private calls, I do tell people, hey, this is an illustration. We're making some educated guesses because we can look at 20 years worth of data in the S&P, but that doesn't necessarily mean that's what the next 20 years are going to look like.
Yeah, of course. And it doesn't work at 3.5. It doesn't matter, but it doesn't go. The S&P isn't 3.5 each year. There's one year it's 10, the next year it's negative 10. So you got to understand that.
Right. Yeah. So there's gonna be some variability here. I mean, we're looking at an illustration, a projection of some values.
Right.
But yeah, I mean, there can be a year we get 1 or 2% because the market's kind of flat. There can be a year we get 0 because the market doesn't do anything. There can be a year we get 10% because it's a really good year. Most of the years are probably going to be somewhere in the middle of the road range, like the IUL tracking the S&P. Like you said, 2, 3 out of 10 are going to be zeros or really low yield years, but that still leaves 7 to 8 out of 10 years where we're making some decent gains on the cash value. So we want to make sure that the client understands that it's not quite like a whole life policy where if they're paying a dividend every single year, your cash value is for sure going to be worth more than what it was last year. The IUL is going to be different. There can and will be years where you get no growth. But there are ways to mitigate that where we can kind of hedge ourselves a little bit. There's a variety of different indexes we can choose to track, and the insurance company also has a fixed account. And that's normally what this middle column. Normally the middle column assumes more of like the conservative like fixed account return. So the insurance company does have a fixed account where it's like, oh hey, we'll pay you a flat 3% or 3.5% or whatever. And so we can say, okay, well, if we want to hedge ourselves a little bit, maybe we have 70% of our cash value allocated towards the S&P index account and 30% allocated towards the insurance company's fixed account. So if we get a 0 year on that S&P index account, we at least get something that we earn in our cash value in that fixed account. And maybe it just pays for the insurance that year. Because if the cost of insurance deduction is about 1%, and you have about like 30% of your cash value that makes around like 3 or 3.5 or whatever, it can at least pay for the insurance deduction that comes out.
Gotcha.
So there's some things. I mean, Oh, go ahead.
Right. Yeah. You have to monitor it, right? A lot of people just don't.
Yeah, absolutely.
You need to monitor that if you're gonna play that game.
Correct.
So, do you mind?
The IUL does need to be monitored more than the whole life policy for sure. Like it's a little bit more complex. There's more moving parts. So yeah, I agree with that 100%. If someone has an IUL, we're gonna want to. And I just have done this recently where. With some policy reviews that I had with some clients, we, made some changes to their index allocations. And, that's just something you have to do. So sometimes you gotta move things around a little bit, just like anything else. This isn't like a set it and forget it. We do it and then look at it for 10 years. Like that's where a lot of these universal life chassis type policies run into trouble. If we're not reviewing them, and doing the routine maintenance type stuff, we're going to be able to catch things before they become a problem if we're reviewing the contract and monitoring performance. So
love it. Can you fast forward? I'm assuming you've got maybe all the stuff here. Let's go down in time, and I just want to see and get your take on. You mentioned about the potential of lapse. Of course, that's what I would wonder about. A lot of people give me policies to look at. And I just want them to understand, look, when you get to this year of the policy, this thing says based on guaranteed, based on non-guaranteed, whatever, we're looking at the potential of a lapse. Do you understand that? If you wanted to use it in retirement, do you understand, in the 40th year of this policy, it looks like you'll be 70, 71 years old, but a little bit earlier than that. Do you understand that that's when you were going to use this money? And at that point, you've got the potential, or based on the projections on this column or these things, you may lapse. It will lapse according to this. So just making sure they understand. I just need to see how you help people understand that potential possibility or the guarantee of what the paper says.
Right. So this is like on the guaranteed side. And again, this is why we want to be pretty picky about which carrier we use for the IUL. Because again, they're assuming the maximum insurance expense charge, and they're also assuming that the IUL cash value only earns 2%, like a flat 2% the entire time the client has the which is just never going to happen. We can say that about a whole life policy too. Like say we're looking at a whole life policy with Penn Mutual or One America or Lafayette, a carrier that's got a really good track record, pays a good dividend. I mean, we can't say that it's literally never going to happen. I mean, we've seen like Ohio National where they demutualize and stop paying dividends, but at the same time, Ohio National, they weren't for a long time. They weren't really like one of the top, A-rated carriers for whole life insurance. Like they had some issues for a while. But even a company like we can say Northwestern Mutual, for example, they were a very, very good dividend paying insurance company. In late 90s, early 2000s, they had one of the best dividends. Their dividends a little bit more conservative now, but they're still a big player in the industry. So we can say with some pretty good confidence that I mean, hey, look, we want to understand if we don't get any dividends ever again, this is what happens. But again, highly unlikely. There's a very low chance of that happening. And we can say something similar with the IUL, that this is assuming we're only getting 2%, which is just not going to happen, because if we're tracking the S&P, we're going to make a hell of a lot more than 2%. Now, there can be some years that we get 2%, for sure. But over like a 20, 30, 40-year period, is it going to average 2%? Definitely not. Now, maximum charges, that is something that could be a problem for sure. So again, that's why we want to be picky about the carrier we use. Look at their historical insurance costs. Have they deviated from their current charge schedule? Have they charged maximum charges before? If they have, that might be a carrier we don't want to use. So yeah, I mean, based on the guaranteed column, the policy does not last. But this is also assuming that I'm drawing income out of.
This one is okay.
Yeah, I'm drawing a lot. This is assuming I'm drawing 130,000.
Talk about this one on TikTok. Yeah, where you're drawing out, which of course illustrate the policies to do different things. And this one you actually are pulling.
Right. Yeah, so we're assuming I'm averaging a 6% return. So again, going back to like monitoring the performance, is it going to perform exactly like this? Probably not.
That's not. Yeah.
Are we gonna want to review the performance when we're using it as income in retirement? Oh, absolutely. So maybe when I'm 65, I get a 6% return that year, and I take out 137,000. Use that as income in retirement. But maybe the next year is when the bear market starts, and that's a year I get zero. That's a year I get zero. Am I just going to blindly take out 137,000 again after getting a zero growth year? Probably not. I'm probably going to modify a little bit. I might take out less. I might take out nothing at all, because I have rental properties or dividend paying stocks or whatever, or my whole life policy that I have to make up the difference. So, we're going to, and maybe one year I get 10% and I can take out more than 137, or maybe 1 year I get, I don't get zero. Maybe I get 4 or 4.5. And instead of 137, I do like 80,000 or 70,000 or whatever. So we're not going to want to just, and that's why it shows it lapsing out on the other two columns, because that income that I'm drawing from the policy is based on the assumption that I'm averaging a 6% return. So if I'm not averaging a 6% return, I'm of course, I'm not going to want to take out that much income if I'm not averaging a as good of a return as I'm expecting. So we're going to want to pace ourselves. Like the IUL is something that we review from year to year. But yes, we do want to understand that the risk to us with the IUL is that the carrier goes to maximum charges, and that could be pretty problematic if we're not getting a good enough return to make up the difference on those maximum charges. It really could absorb a lot of the cash value, and we're gonna want to be picky about the IUL carrier that we pick, because the maximum charge is the risk to us using this as an asset.
Right. Well, hey, tax-free Mike, I appreciate that so much, and appreciate the look even at your personal stuff. One thing that's great about you, and what I see on TikTok especially, you guys got to follow this man, is that he's going to tell you and show you numbers based off things he actually does.
Correct.
And
my own
a lot of people have to make Right. It's got his name right here at the top, Yep. And so we appreciate that, man. So thanks for coming on our podcast and having a healthy conversation around this, helping people understand, number one, there is a difference, and what are they when it comes to utilizing this infinite banking type of idea, a permanent life insurance product for the process of utilizing capital, moving it around. So we appreciate you so much, my friend. We're going to have to call it at this point. It's been so good. I know we'll have you back if you'll have us.
Sure. Yeah, I'd love to come back.
Yeah, man. But we'll wrap it up at this point. We might get a little more detailed next time, and maybe we'll go into some stress tests that you mentioned. So Appreciate you, man. So one more thing. Where do we find you online? We know about the TikTok account. What about Instagram, Facebook, or maybe even your website?
Yeah, so that's having my own website is probably something I should do pretty soon. I mostly just use social media. So on all platforms, Instagram, Reels, Facebook Reels, TikTok, YouTube, Pinterest, even if you're on Pinterest. Tax-free Mike. I'm everywhere on all the social media platforms. I'm tax-free Mike. Even Twitter. I don't do much on Twitter though, but look me up on all social media, and I'm tax-free Mike. There's a bunch of these videos where I talk about IUL and whole life and infinite banking, retirement. So yeah, I'm available pretty much anywhere you spend time scrolling away into the wee hours of the night on your social media stuff. There's a pretty good chance I'm there.
Yeah, man. Well, we look forward to seeing you there and back here in the future,
Perfect.
man. So appreciate it. Have a great time, everybody, figuring out what's going to be best for you as you learn to crack the code to cash flow.